Hello everyone, my name is Siddharth Pal, and today we will be looking at the Black-Scholes equation. Here is the formula right here, and this was created by three genius economists, Fisher Black, Myron Scholes, and Robert Merton. What they did was that they used this formula to be able to value and price the value of a call or put option. And so what is a call or put option? They are considered derivatives in the financial community. What that does is allows you to value allow you to value the price of an investment. So what that could be is saying, say Netflix trading at $60 right now. What is the price for an investment saying that this will be trading at $65, tomorrow? So like that, yeah. And if you know anything about the 2008 financial crisis, the reason why that happened, people were undervaluing or overvaluing the price of these derivatives, causing an entire tumultuous collapse of the stock market and the housing market. Okay, but now anyways, this is used for the European and call put option, assuming that the stock pays no dividends. What a dividend is a way for the stock or the company that the stock represents for them to reward shareholders simply for just buying the stock. They'll give you a portion of what you bought, just automatically given to you. But in our case, we're not going to assume that. All right. Now there are three components to the Black-Scholes equation: geometric Brownian motion, Ito's lemma, and a delta hedge portfolio. In geometric Brownian motion, we're going to have this formula right here. ds is equal to the expected return of a stock given a small change in time, plus the volatility of the stock price given the formula for dt being a random variable times the square root of dt. And so, this seems generally nice. However, if you think about the value of stocks, often you'll see that they compound in value. It's never just like a straight line, is it really? It's not. So that way, we're going to use geometric Brownian motion, which is going to have this S value right here. That's going to account for the compounding values of a stock. Now we're going to look at Ito's lemma. Ito's lemma is derived from Ito calculus, which is like a form of stochastic calculus. We didn't really talk about stochastic calculus in this class. It's something a lot of us will look at later on in the future. And I can't really go too in depth about it, but we will use this formula as that will allow us to derive the equation. So we have this right here, and we see ds. So what we know is that, I'm going ahead of myself. Let me stop. All right, we have delta hedge portfolio. This is a long position in a call, short position in the stock. That's the equation right here. Now let's look at the derivation. So we're going to have geometric Brownian motion. What we're going to do is we're going to square both sides. And this entire function right here, if you square it, you're going to end up with this. Now we know dt, we said is going to tend to 0, so dt squared, automatically going to cancel away. You have dt times dz. We know dz, we said, is dt to the 1/2. So there we know that this is dt to the 3/2. Therefore, we can say this tends to 0. Now we're just left with this by itself. If we look at the derivation of Ito's lemma now, we can see that we can plug in ds, which we got right here. If we plug that in, we can now factor that out with dt. We'll end up with dt squared and dz dt, which we know those are going to both tend to 0. That way this whole thing cancels away. Now you see this dt squared, that's going to tend to 0 as well, cancel away. Now you can see right here, we're going to have this ds squared. We look back to our squared answer right here, we can plug that in. So that'll be all we'll do with Ito's lemma for now. We'll go to the delta hedge portfolio. Delta hedge portfolio, you're going to have this right here. We're going to say, first we're going to do the first derivative. So you're going to end up with this. Now we know dv is this entire thing right here. And now here's where it starts to get a little confusing. We're going to say that delta is equal to the partial of v with the respective s, and we are going to plug that in right here. And here's where it gets a little confusing. Not sure how we got this step, but I looked through every single website or whatnot, and they all seem to do this. I think if I do some more research, understand more of the mathematics behind it, and like what the delta hedge portfolio represents, I can understand how they end up getting these values. However, at the time this came out, just didn't have enough time to do the research, and I'm sorry about that. But in the future, I'll definitely be on the lookout for this. All right, now we have pi equals v minus delta s. And we know that pi is right here, so we can substitute that in. We see dt is now common for all these different expressions. We can cancel that away. Now we have this function right here, or this equation right here. What we can do is we can distribute, and we know that we said delta is equal to the partial of v with respect to s, so we can substitute that in right here. And this, ladies and gentlemen, is the Black-Scholes equation. Alright, and so here is an example. This is just showing what you can see. Like if you look on TD Ameritrade, you'll see that they have the value of a call option, put option, all priced right here. And here's the values. So saying Netflix is trading at $273. What is a put that is going to be at $280? What is the call that's going to be at $270? So things those investments and the prices available that you can get. Now this formula allows you to determine what that price is, which is a good thing for valuations, given that, say you're a bank, creating these valuations, or a brokerage. So now let's look at an actual example. Say we're looking at a stock price, Square for example. Typically they're trading at about $62 right now. And we're going to say that the exercise price, which is the time or the price at the point of expiration, is going to be $60. The time to our expiration date will be $40, which will represent as 40 over 365, since there are 365 days in the year. And volatility, which is 32% or 0.32. And risk-free interest rate, this is just how much the stock will increase without any real factors affecting it individually. Now it'll be 0.04. And also the volatility, you can get that off the internet if you're looking at a stock. That will be its standard deviation in price over the past 365 days. Now, if you look at our formula right here for the value of a call option, you'll see that there's two important components, D1 and D2. Alright, so D1 and D2. If you look at that, so D1, here is the formula right here. And what this is that this is going to be the natural log of the initial stock price over the exercise stock price plus the risk-free interest rate plus 0.5 times the standard deviation squared times the time till expiration all over the standard deviation times the square root of the time till expiration. So we're going to use all our values right here, plug that in, and we're going to get 0.404. Now to get D2, we're going to get this value minus the quantity of the standard deviation times the square root of the time till expiration, and we'll get this value. Now we can use the z-scores from our standard normal table. We can plug that in, look at that right there, and we can see the probability of this occurring is going to be 0.66554, and the probability of ND2 is going to be 0.6179. Now we can plug that into our formula. Boom, 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 boom. And we get 3.72. So we know that given these factors, we will be able to value a call option at $3.72. And if you want to look at a put option, similar thing, right? You're going to have the value of the call option, $3.72, plus the quantity of the exercise price over E to the times the E to the quantity. So that quantity is going to be the risk-free interest rate times the quantity of the time till expiration, and we're going to multiply that, or I'm sorry, subtract that from the time till, the exercise price, and and boom, you're gonna get 1.46. The value of the put option is $1.46. And so this was a really interesting project for me. I really enjoyed learning about it. I've always been pretty interested in finance. However, like I've always learned it from like a fundamental perspective. You know, just you look at a cash balance sheet, invest in what you know, things like that. And you know, I always want to know like, you know, can I really use like my mathematical aptitude doing this? And so this was one way for me to be able to explore that. And I look forward to looking into this into the future. Uh, Thank you, Math 80.